Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app. We're going to start strong. Stuart Kaiser is going to be with us on the equity markets here in a moment. Tom Purcelli on later, of course, on Fed Day and the myriad challenges that Jay Powell has. But we start especially strong. Do you know she's an Iron Woman?
Really?
Gargi's out at Jones Beach.
Okay.
She's like, we're puny. I mean, Gargi is tough as nails with BlackRock. And, she's doing the Iron Man thing and all
Iron
that.
Man? What is that?
It's like triathlon, but tougher.
No.
I don't know. Gargi's with us this morning. Gargi, thank you so much for starting strong. What happens to your world if rates keep going higher?
Good morning, Paul and Tom, long-time listener, first-time joiner. Really excited to be here. So what happens to my world if rates continue to go higher? Two things. Number one, there's going to be continued focus on selectivity within equities, and the areas of the equity market in the U.S. that have earnings growth are going to continue to outperform. So that's number one. Number two, and we've been talking about this for a while, and Tom, you and I have chatted about this before, but the long end, anything sort of longer than the 5-6 year part of the interest rate curve, is going to become more and more difficult for investors, especially given that there has been 5% that you can earn or more in cash. So I think two things for investors to keep in mind is staying in high quality in the equity markets and staying in the very front end to maybe the belly of the curve in fixed income markets. I think that's going to be the impact.
I'm looking at the real rate. Kenneth Rogoff of Harvard was with David West in Wall Street Week. Look for that this week. And Professor Rogoff is riveted on the real yield, the inflation-adjusted yield. I'm sorry, Gargi, if it walks like a duck, quacks like a duck, it's a duck. And the 10-year real yield, I'm rounded up to 2.28%. Is the real yield walking away from us?
It looks like, obviously it has risen pretty meaningfully for good reason. If we look at the month of April, everything that we have gotten so far, whether it's the payroll data, whether it was ISM in the beginning of the month, whether it was CPI and PCE, all of that have contributed to yields moving higher. What I will say, though, and this is something that we lay out in our spring investment directions, is owning real rates in the very short end, so sort of the 0 to 5 year part of the curve, we think make a lot of sense. And if you look at returns for the month of April, and if you compare sort of what STIP has done versus many of the other front-end securities or longer-end fixed income securities, you've actually been a little bit more preserved being in the front end of the inflation-linked curve. Why? Because inflation has surprised to the upside, and for a big part of the month, oil was surprising to the upside as well. So we do think that front-end inflation can be a good place for investors to be invested in, especially at these really strong real rates. But again, keeping your duration short is very important.
So, Gargi, I like the keeping the duration short call here. Should I just park my money in the 2-year United States Treasury at 5.03%? Is that the trade, or should I take some credit risk here and maybe, I don't know, corporates or high yields? How do I think about credit versus just the Treasury market?
Yeah, look, it's really attractive. You look at 2 years, you look at where they are, where it is, and it's certainly very attractive. But I would also say that as of right now, the economy looks good. Yes, the first look at the first quarter GDP was a little bit softer than expected, but we're still growing much higher than what expectations were coming into the year. So credit, we think, will remain okay. And if you look at owning sort of that front end corporate credit, maybe in the 1 to 3 year part of the curve, you are picking up a little bit of extra carry, and we think that makes sense. And I want to highlight, though, that especially given how tight spreads are, both in IG credit as well as high yield. When you look at percentile levels, they're at their richest that they have been on a spread basis. But then when you look at all in yield basis, they're obviously a lot more attractive. So I think selectivity really plays a role here. So looking at, we're telling investors, if you're looking at high yield, go into defensive high yield, and look at, if you're looking into corporate credit or even securitized asset, go with an active manager that can actually pick the bonds for you, where you can earn your income, earn your carry, but at the same time be a little bit preserved for some of that downside, given the level of the tightness of spreads.
All right, for those out there that want to take some equity risk here, I mean, I'm not sure what to do here. I mean, we've all kind of grown up over the last 15, 20 years with technology leading the way. Do I just stick with the big tech names, or do I try to find some value out there, whether it's financials or energy or consumer staples?
Yeah, so, again, if we look at just even since the earnings that have come out just over the last week or so, I think what we're finding is that earnings growth is coming, it is surprising to the upside, which is part of the reason why last week we had a okay week in the markets. I think focusing on areas of the market, of the equity market, where earnings growth remains stable, which companies which are able to generate cash flow, companies that, very importantly, have low leverage, and we call that high quality companies. I think that is what investors should focus on. And the question that we get over and over again from investors, from clients when they're building their portfolios is that, is this the time to get into cyclicals, and is this the time to get into small caps? And that is where, when we look at a portfolio analysis, we see that investors are largely overweight small caps, and we think that in this rising rate and a higher rate period, away from the small cap and into larger companies, larger cap quality companies is what makes sense.
Gargi, we got to leave it there, Gargi. We're out of time. Gargi, we're out of time. Thank you so much. Gargi Chaudhuri with us with BlackRock. Stuart Kaiser with us right now. Let's get right into it. An important conversation. He has been incredibly on this great bull market, a very articulate voice on having the courage to stay in. Oh my word, a drawdown, 4.2%, SPX. I know you're going to tell me there's an opportunity here because you are a bull. What does your world do if Powell or Paul Sweeney force interest rates higher? What happens to the equity world if the real yield breaks through to 2.30, 2.32%?
I mean, there's definitely going to be pressure on markets, I think, if real yields keep rising. To us, it's more the velocity move than the level, though. I mean, I think if we move 20 basis points higher and then stabilize, I think equities can deal with that just fine. But, what we've had is just a very rapid, sort of acceleration higher that's been disruptive.
Am I stunned that the VIX is 16.08? When I look at the interest rate soup into the 130, the Fed decides, folks, today on Bloomberg Radio, when I look at where we are in a 16.08, that's feeling like a 20. Why is the VIX 16.08?
Yeah, look, I think the reason the VIX is, I think, lower than most people expect is because the market's not realizing a lot of volatility, right? The realized volatility over the last 10 days is probably 12.5. So it's pretty hard to get the VIX higher when day to day the equity markets just aren't moving that much. Rule of thumb, 16 VIX is a 1% move per day implied over the next month. That's actually high when you consider what we've had recently. So I agree, it feels low from a risk perspective, but just, with the markets as stable as they are, it's just hard to get it meaningfully higher from here.
Stuart, as you walk out to the Citi trading floor at 390 Greenwich Street in Lower Manhattan, are your traders there when they're talking to their clients? Are their clients wanting to take risk here, or are they more just, I'm sitting on the sidelines here until I get a better sense of what this Fed's going to do?
I think today for the morning, I think people will be sitting on their hands a little bit. There's no reason to take risk in the few hours before the Fed. I think in general, people were happy to take risk until 2 to 3 weeks ago, and then you had kind of oil move higher. You had some bad news out of the Middle East, and then frankly, what you're seeing in in AMD, et cetera, overnight is a repeat of what we saw out of Taiwan Semi and ASML and Netflix, which were some big sort of semis-focused stocks made really large moves on earnings. And I think when that happened, it impacted us as well. We took a step back and said, wait a second, if these kind of high-flying stocks are under this much pressure with what I would consider decent results, then maybe we just need to be a little careful. So I think investors are trying to digest all these various risks. And then obviously the GDP report definitely got people's attention, without a doubt.
How about earnings? We're halfway through kind of earnings season here. We had Amazon last night, Apple after the close tomorrow. What are you guys seeing in earnings, and what's that doing to your call here? Is it impacting your call at all?
I tell you, we were a little concerned going into TMT earnings last week. Frankly, they put up solid results, and that got the market higher. So I think by and large, we're getting what you would call a pretty solid quarter, like a modest beat on revenue, solid beat on EPS, and the biggest stocks in the market are delivering. So I think that's gotten people fairly comfortable after what I mentioned was a little bit of a wobble kind of coming into the season.
This came up at the dining room table last night.
Really?
Shake Shack catered. That was great. Afterthought picked out the food. Stuart Kaiser came up at the dining room table, which is how partitioned is this market. My basic take is forget about Magnificent 7, the Magnificent 20 are ever separate from the other 400x number on the SPX.
Yeah, I think that's right. Tom, we've been sort of in this broadening theme. The problem with the broadening theme for us has been it doesn't work in two conditions. One, when you have risk rising, and two, frankly, during earnings. Because the fact is your Microsofts, your Apples, your Amazons, your Googles are just putting up huge numbers. And it's very hard to get the market to broaden out.
Okay, but how do you use your theory in textbooks? Somebody had out a summary of the net new revenue of the three major cloud companies. We've never imagined those numbers before. So then how do you do your day-to-day work? How odd this tech juggernaut is.
Yeah, I mean, look, it harkens back a little bit to the late 90s when you were basically introducing a new technology into the system, and you assumed and forecast really large revenue growth, but you were a little uncertain about, both the size and timing of it. So I think what you're having is, to your point, people are compartmentalizing a little bit, right? Like, I need to have some AI exposure on. Let me choose the way to do that. And then off to the side of that, I kind of need to model the rest of the market, as a little bit independently. So it is a challenge, but it's a good challenge to have, right? I think it's a good challenge to have that you have this large thematic revenue growth impulse kind of coming through the system. And look, this is why we've kind of joked the NVIDIA earnings report in late May is priced as big an event as payrolls on Friday. So to your point, it just knocks home.
Say that again. That's important. Say that again.
So if you look at S&P 500 options, they're pricing as much risk into the NVIDIA earnings print as they are into payrolls this Friday. So to your point, this not only is it a big theme, it's also an uncertain theme. And even at the S&P level, that risk is being priced very aggressively.
So Tom's been long the Magnificent Seven. I mean, he doesn't even come into work many of these days. He's planning his trips to Paris and everything. The rest of us, though, what do we do? I mean, do I look at energy? Do I look at healthcare? I mean, what are the smart people at Citi saying these days?
Yeah, I think there's a couple sectors people are kind of sniffing around. One is healthcare because healthcare underperformed so much last year, and you also have the GLP-1 story, which is not quite an AI theme, but is sort of in the same general sort of category as that. I think industrials is a big focus right now, just because of the IRA spending that's coming through the system that's just hitting company revenues right now, and some of the reshoring story kind of falls into there as well. So I think industrials and healthcare are two big areas of focus for a lot of clients. It's not just by the sector. You're choosing stocks and subtexture, but those are very important.
I'm looking at 15 upgrades today on Amazon across global Wall Street, including Citigroup, and they're all different levels, and it's a parlor game. Where are you a year now on SPX? Does Stuart Kaiser have to lift your SPX numbers simply because of tech?
Look, I think it's definitely potentially an upward lift on the EPS number. So Scott Kronert, who runs equity strategy, he's at 245. We're a little bit above consensus on the EPS number.
And you're going to nudge that higher, you're suggesting? I understand.
We shall see. It looks like we're going to beat consensus by more than 5% for this quarter. We revised up consensus by 3% last week. So certainly the pressure is to the upside, I think, for the earnings.
Rich, can you run out Stuart Kaiser and a Bloomberg? Red sticky. Kaiser says 250 from Citigroup.
Exactly. And Citigroup, I mean, 388 Greenwich is where I work, but the people who actually get stuff done are at 390 Greenwich, the traders, the salespeople. What are your traders saying to you as you walk through the floor these days?
I think, honestly, people have been a little surprised at a little bit of just the lack of activity the last couple of weeks. The markets have been moving, but volumes have probably been a little lower than you might have expected. I think the one notable thing in the last couple of weeks is you did get a bid for sort of tail risk protection about a week and a half ago. So people buying call options on the VIX, to Tom's point. So I think that was pretty notable. It's the first time we've seen people kind of, making sure they had that tail risk protection on.
I can just say, folks, it's fascinating right now. We're going to have a lot of fun through May on Bloomberg Surveillance. Stuart Kaiser, thank you so much for coming in. He's with Citigroup. Sweeney demanded we have to talk Paramount. We have to talk media, the future of TV, and that can only mean Brian Weiser of Madison and Walls. Let me get one question in here before Sweeney takes over. Brian, what is Sherry Redstone waiting for?
I don't know. I mean, here's the thing. There's this fine balance between making the most of her personal position or her family's position and being mindful of any legal obligations that she has. And then there's any sentimental subjective preferences that she has. And I think it's what makes it so complicated. It's not just about the highest enterprise value.
So, Brian, it kind of goes to the bigger picture here. I mean, Sumner Redstone might look like the smartest person in the room because he sold out years ago before the media business, the deterioration, really accelerated here.
Well, you could say he didn't sell out. He exited the business.
Yep, exactly. So
he never sold.
Yeah. So, Brian, what do you think here? I mean, what's the future here? How are you thinking about some of these traditional advertising-driven dependent companies? Like the Disneys, like the Paramounts, like the Warner Brothers Discoveries, as they transition to streaming, are they going to make it?
I mean, here's the thing. If they keep doing what they have always done, they'll get what they've always gotten, and at least in recent years, which is to say a negative trajectory. I would argue that there is still lots of opportunity ahead for any of these companies, Paramount or otherwise, as long as they invest in the right direction for the future. And basically none of them are. That doesn't mean that they can't. But I've argued that, certainly for the ad-supported platforms, the pathway forward is to become a platform, meaning you got to eliminate this idea of being a television-based company. Okay, well,
this is so inflammatory, what you're saying, Brian. I'm going to cut you off. For example, I just saw on Variety, there's 5 pilots this season across 7 networks. 2 of the networks don't even have any pilots. What is the Weiser prescription to save streaming?
Well, I think that subscription-based pricing is one thing. There's a lot of room for pricing increases. That's one thing. There has to be a lot of investment in programming and good programming too, right? Not just cheap programming. So that's part of it. I think that actually this is going to be a little bit of a different view, but I think that if they actually kept investing and didn't put the brakes on it, if they actually tried to become a global platform, if they doubled their spending on streaming programming, for example, and made sure that they were a more meaningful platform, they would have had liftoff trajectory, I think, in a way that would have helped sustain the business. The problem is that it's never going to be as profitable as the business is replacing. And I don't think that most companies understood that you're going from what would have been a 30 or 40% margin business to one that's more like a 10 or 20% margin business. How do you make up for that? You make sure you're 2 or 3 times bigger. And it makes sure that you apply your platform globally. You limit how much you're giving up your economics to other partners, which Paramount was doing certainly in much of Europe. They kind of underinvested elsewhere before kind of throwing in the towel with Sky Showtime.
So, Brian, just in terms of total ad spend, give us a sense of is there enough ad dollars to support broadcast and cable television as we all know it, as we all grew up with, or is it all going digital?
Well, this is where I'm going. If you're competing, and we're talking about 2 kind of parallel but separate things. One is subscriptions, getting consumers to spend money on subscriptions, right? In the United States, there's about $140 billion a year spent on subscriptions, video in various forms, right? Streamers right now are only tapping into about $35, $40 billion of that. There's still a lot of money to be gained
Okay, but Brian,
from building a subscription
this is
product.
brilliant. And then we have such a respect for Brian Weiser going back to Tom, shut up, Facebook will be successful. Brian, what's going on at the lunch tables in Hollywood? They're all sitting there with their perfect water for some perfect well in New Zealand. Okay, great. What are they actually talking about if they're so far off the mark of the economic opportunity?
I honestly don't know. I'm not at those tables, I guess. No, but I think that there's this inherent conservatism. It's true in most organizations, right? Like, there's a handful of people who can make decisions to make radical pivots or meaningful investments or bet the farm kind of actions. And those people would be the likes of Sherry Redstone, right? I actually think that Bob Bakish was doing the best he could within the constraints that he had to work with, from everything I know. And I think that the problem is there are a small number of people who can do it. And then they have to be able to persuade investors of their plan. And most aren't willing to do that. They think investors need their short-term returns. Investors need short-term returns when they're not given a persuasive reason to believe otherwise. This is something that most companies at the CEO and chairman level do not fully understand in my experience.
Paul, it comes down to the heart of the matter. At Michael's in Los Angeles, in Santa Monica, they're over there salmon and caviar carpaccio at $27.
Nice.
What are they talking about? Shouldn't they be like in a full panic, Paul?
I think, the question and Brian knows this very well, is trying to kind of replace that traditional distribution model of cable and satellite and all that great money that was associated with those subscriptions with streaming. So, Brian, as you step back here, you think about the Paramounts, the Warner Brothers Discoveries, I don't know, maybe even Comcast, I don't know. Who kind of is going to be standing here 5 years from now other than Netflix and maybe Disney?
Well, Comcast and Disney are definitely well positioned because they do have so many other revenue streams. They can sustain and support this transition to a much less profitable industry, right? And that will buy them time. And if nothing else, you can grow when you take share of a shrinking business. And so that's all good for them. I think that the industry level opportunity, though, as I say, on the subscription side, invest more heavily, not less heavily, in content. You can build a bigger business and do it globally because there are real efficiencies. Netflix has taught us this, haven't they? Other than Amazon and Apple, right. Everyone else has given up. Okay, on the advertising side, the fact that it's video, it's professional, it's premium video, doesn't matter like it used to. It just doesn't matter.
Yep.
Okay. And here's what I'm saying, that today's studios, owners of networks, need to think differently about their advertising platforms. They need to be indifferent about the fact that they've got professional video. They need to be able to embrace the likes of YouTube and user-generated content.
Right.
They need to be able to embrace other content.
We got to leave it there. Brian, thank you so much. Brian Weiser there with Madison and Walls. And that's exactly what I heard from Mark Thompson in the FT interview from CNN. Your daily look at the front pages, particularly on a Fed day. I looked at Lisa's newspapers today. I get a preview from her People, and
I know she has people.
Wow. I mean, there's like 18 stories to pick.
There's a staff behind this. I'm telling you, a staff of one. All right, we'll start at the Wall Street Journal. It has an interesting story. Americans dividing their food shopping among different stores to save money. Consumers making 8% more trips to different stores because that's a big part of their budget, right?
My mother used to do this.
I still do this.
Do you really?
I
So
go
what do you
to
do?
the farmer's market for all my produce.
Okay.
So because it's cheaper to get it
So
there.
does your town have a farmer's market?
It does.
Okay, there you go.
Yeah, so I go to the farmer's market for the produce. Then I get, things I need here and there at, the local town supermarket. And then I go to Costco for the big stuff that I can just save in the long haul.
Yep.
How much do you save at the farmer's market?
Oh, significantly. Sometimes half the price.
Half? Really? Half?
Yeah,
like
no, it's a big difference.
Oranges, half the price.
Strawberries, berries, all the berries.
See, the farmer's market in my town is more of a social thing. Kind of
It's
seeing and be seen on a Saturday.
Exactly. You show up. Here's the difference, folks. Lisa's out there with bags of berries.
Exactly.
I have my good friend Bob in Washington. That's all he eats is berries.
Yeah.
And that's all right, Lisa. Like
good for you.
gallons of berries,
yes.
right?
Antioxidants.
We just go there and get our apple cider for the kids and walk around.
Where Paul lives, the farmer's market is a bunch of Range Rovers
Right,
pulling up.
exactly.
Going,
Investment
what
bankers
time
pulling
the
up.
Giants
But
play?
it's
Next.
true. It saves a bunch of money. I'm telling you, it gets tight. So the next one is from the Financial Times. Pfizer actually looking to cut out that industry middleman who wants to sell some of its medicine straight to consumers. So it's developing this online platform. You can order medicine like Paxlovid, a migraine nasal spray. It'll launch later this year. So it's connecting customers with telehealth consultants to prescribe it, and then a drug dispensing partner who's going to ship out the prescription. But Eli Lilly, I mean, they did something similar earlier this year. So they're just trying to kind of cut out that middleman.
And hopefully at a lower price.
I was about to say, maybe the price.
First of all, President
Yeah.
Biden and former President Trump both wanted to lower prices. I mean, Donald Trump made a big deal about this. Are we actually going to finally get prices like 18 other countries?
Oh gosh,
I don't know.
hope
That is. I mean, I'll tell you what. Here's an issue that I will never profess any knowledge of: healthcare economics. I just don't understand it. I mean, you can get a PhD in that.
You can be Uwe Reinhardt down at
Yeah.
Princeton, who was very generous to us years ago, the late Uwe Reinhardt. And
I mean, who pays for
it's
what?
it's a mystery, yeah. What else depressing? What's next?
Well, you know, you can also get cheaper overseas as the weight loss drugs too. That's another thing. That leads to our next story. This is from the New York Times.
This is really interesting.
Yes. Okay. So weight loss drugs are very popular, but the stress around social etiquette, that is becoming an issue. Like, is it okay to ask someone if they're on weight loss drugs, or is it rude? You know, that's the
a great
question
point.
being going around. Barbara Streisand, she sparked a debate. She was posting on, commenting on Melissa McCarthy, the actress's picture. She said, "Are you on Ozempic?" and people got offended by. They're like, "How can you ask?" You know, or
So that's
something like
personal
that.
information, I guess.
That's what they're saying. You know, it's that the borderline now. Like,
Boy, you
is
look
it
great.
okay?
You lost a lot of weight. Good for you. And just leave it at that, I guess.
Yes.
Okay.
No one's.
Certainly.
And I've actually experienced this with
you did?
an acquaintance, and I was told, do not mention the drug.
See?
Just say congratulations on your weight loss.
Because then you're suggesting what they need
But
extra help, or
I don't
they
know.
need
It's all new.
all good.
To be honest, Jon Ferro was way out front on this. I was like, look at it, John.
Well,
What are you,
he's got like
nuts?
no body fat,
No,
period.
he does.
he doesn't do it.
He's in the gym like at
Yeah.
10 a.m. But, you know, Ferro was way out front on this. And I look at the whole thing, and I go, I can see if they're on Ozempic. Lisa, can you tell?
Well, in the face, I mean, my aunt's on it. She dropped like 40 pounds.
Wow.
I mean, you could tell right away. But it's that question. Like, I knew she lost weight, but I didn't say, "Hey, are you on Ozempic?" You know, it's kind of like she suggested it to me.
Can you
like,
get
she
it
brought
now,
up.
Paul? You've been great on
Yes,
this.
yes.
Can you get it now?
Yes, and actually, what we've learned is they will only put you on it, get you started when they feel like they can always have your refills done. So it's a supply issue. Once they feel comfortable about the supply,
Right.
they'll put a new person on it, and that seems to be how it
Well, that
works.
was depressing. Next.
Here's another one. The Paris restaurants.
Uh-oh.
Yes, they
Tom,
are
pay attention, your
scamming
Paris restaurants.
tourists ahead of the 2024 Olympics for tips. Okay, because tipping culture in France, as you know, it's different than in the U.S. Okay, they have a legally mandated 15% service charge.
Whoa. They have a legally mandated what?
15% service charge.
Okay.
Menu prices often higher to cover it. It's called a pourboire. How do you say it? Tom, help me with this.
Well, that's good.
Pourboire in French.
It's really interesting.
It's a different tipping culture, but the restaurateurs are playing into their international guests' kind of ignorance by nudging them to pay like they would in the States. So they're good. You may start to see like the tablets where they flip it around and it gives you that little percentage.
Yep.
Even though the tipping culture is different in
That's
France.
obviously the first thing I
So-
learned when I moved to London in '87.
Oh, you did? Oh.
No tipping. It took me weeks to figure that out.
My take on this is they love Americans because most Americans tip over there like they tip in America, which the French love. But the worst, I get upset in London. The way they have it set up in London is detrimental to the workers. It's not fair to
you don't
London
tip in
bartenders.
London, do you?
No, it's terrible. They're taking.
But I always
to the
leave my change
cleaners.
on the bar, you know.
Nobody has change in it. Nobody carries money anymore, and
Yeah.
it's really unfair in London. And in Paris, you know, my experience is they love Americans. Like cab drivers will fight to take the Americans. Not that they could ever tell I was American. When I
How do you tell?
And Tom has the standing tables at all the best restaurants in
I do.
Paris.
There you go.
So he's got his people over there.
Starbucks, les book de star. They know who I am. Lisa Mateo, newspapers. Thank you so much. Greatly appreciate that.
This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.